What's year-end window dressing? Year-end numbers vary. Some years are good, some bad. One sector rockets while another melts down. There's war or peace, election year or not. But always one consistent annual rite of passage inevitably takes place around Christmas. Window dressing. I'm not talking about Fifth Avenue holiday season frills, decorations, and moving puppets. No, I'm talking about what happens to managed money portfolios, ETFs, private funds, mutual funds, and the like. It's these managers getting their portfolios to look as good as possible for end-of-year statements sent to all investors, seen and commented on by pundits, direction for bullish or bearish behavior for sales and marketing teams raising new dollars, and money managers across the universe comparing themselves to each other and the S&P index. So what actually goes on behind the scenes of each year's Christmas rally when, for instance, a non-performing fund throughout the year can finish with its numbers pushing into the black by December 31st? Funds depend on new investor money and reinvestment coming in and staying in, largely based on investor sentiment due to performance, yield and return, risk or risk averse, but you do not have to be an MIT graduate to realize what looks good at year end places less and less pressure on a poor performing fund facing New Year's redemptions. What a symbolic word, redemption, to redeem. In this case, to pull our money away from an underperforming fund. For a mutual fund investor to make a redemption, the investor must inform their fund manager of their request. The manager must process the request within a certain amount of time and distribute the funds to the investor. The amount owed to the investor is normally the current market value of their shares, less any fees and other charges. So what is window dressing? The term derived from the holiday decorations done every year at department stores to attract buyers to stop, look, and come in and buy. Window dressing is a strategy used by mutual fund and other portfolio managers near the end of the year to improve the appearance of a fund's performance before presenting it to clients or shareholders. To window dress, the fund manager sells stocks with large losses and purchases high-flying stocks near the end of the quarter. These securities are then reported as part of the fund's holdings. What investor doesn't love winning over losing? It's great to give your money to a professional money manager who earns when we do, and in some cases, whether we do or not. Nothing new here. Earning small percentages on minor risk sure helps us sleep at night, but wait, we're MicroCap investors. How does all of this affect us? After all, we're in the market too. Many of us are managing our own portfolios. What about our year-end participation? What about our window dressing? What about our portfolios? The loneliest time of the year for a MicroCap investor begins at Halloween, runs through Thanksgiving, culminates at Christmas, and records its final tally New Year's Eve. Yikes! Selling losers and gainers as sort of a rite of passage can be onerous, especially if losers far outmatch gainers. Yet we, the cadre of risk-reward investors, are truly a faithful bunch. Win some, lose some, and come back for more. We believe there is always a 10-bagger somewhere around the corner. Our mantra: it's easier for a stock to go from 10 cents to $1 than from $1 to $10. I mean, this is a global mantra. Sure, it takes a major special situation to make a 100-bagger, but it happens. Hats off to the one stock in our portfolio that killed it, rather than the 9 that killed us. As the global markets become our field to plow, even more choices abound, regardless of the obstacles, turmoil, or bad press. As I have said before, when the year-end dump-out begins, be ready and loaded with dry powder to passively buy the ones you thought were too high-priced or were so thinly traded you would have to chase. I'll end this piece and the year by reminding, Investors are not a uniform bunch. We have varying risk tolerances, capital, styles, preferences, and time frames. For instance, some investors may prefer very low risk investments that will lead to conservative gains, such as fixed income products. Other investors, however, are more inclined to take on additional risk in an attempt to make a larger profit. These investors might invest in microcaps, emerging markets, or stocks, all while dealing with a roller coaster of different factors on a daily basis. Have a great holiday season. Thanks. This is Ask Mr. Wall Street.